first of all, never get emotional about money. Secondly, always have a stop order on every trade that you do. You need to be trading from a level of confidence. You need to ask yourself the question every time you get into a trade, whether you're on the long side or on the short side, why am I buying this stock? Am I throwing a dart at a wall wearing dark glasses with no idea what I'm doing? No. Am I buying the stock because Uncle Herbie on the internet told me to do it? No. Am I buying it because I heard about it on Twitter Space? No. The best defense against a rug pull and a scam is to do the homework yourself, using technical analysis, using moving averages, using RSI, support and resistance. At the end of the day, no one got broke taking a profit. Never turn a winning trade into a losing trade. If you're in a trade and you have a stop order on absolutely every trade you do, you need to identify how much you're willing to lose in order to make money. So I'm willing to risk $50 to make $200, but I'm not willing to risk $200 to make 50, because if I have one losing trade, it's going to take me 4 winners to break even. So we're out here, to use the baseball metaphor, we're out here hitting singles and doubles, right? At the end of the day, and not trying to shoot a home run. There's no reason you should be in a stock at $50, have a stop order at 49.5. It goes up to 54. You don't take a profit. It goes down to 50. You start losing money. You change your stop order, and you've now turned a potential profit into a loss, right? You cannot be that person who calls me up and says, I ask you how you doing, and you're going, I'm batting 80%. And I say to you, so you must be profitable. Well, no, I'm down $5,000. And I said, well, how is that possible? Well, I had 4 winning trades at $100, and I had 1 losing trade at $7,000. That is not a sustainable trading strategy, right? At the end of the day, you should never, ever be losing $7,000. You should be making $50, $100, $150, $200, small bits, hitting singles and doubles, do what we call scalping the market, right? That's how you end up making money, $200 a day, $1,000 a week, $4,000 a month. You cannot be swinging these things, making 50 or 100 here and then losing 5,000. Trading on hope and hype and all that are not sustainable strategies. So if you get into a stock at $50 and you have a stop order at 49.5 and the stock goes up 50 cents and you sell half your position and you raise your stop order up to break even, you can now no longer lose money on the trade. Not only have you just made 50 cents, but you are trading from a level of confidence because you can't lose money. You've put yourself a stop at the break-even point. That is the best place to be. And then as the stock goes up, right, you do what's called a trailing stop, where you move the stock up and you take profits all the way up. Trading from a level of psychological confidence is the key to becoming a good trader. Psychology of trading is the key. I can teach anybody to hit a button to get in and out of stock and short stock. It's a matter of what you do when you get into the trade. The psychology of it. You got 2 little people on your shoulders. One person tells you to be conscientious and responsible, and one tells you to be a cowboy and Indian, right? Where you're just flinging money. You're flinging money around, Watch it go to 54. It goes down to 49. You buy more. You're averaging into bad trades, all that kind of stuff. So responsibility is key. Following the rules. There are certain rules. The mistakes that unsuccessful traders make are all the same. There are only 2 ways to blow up a trading account. One is not having a stop order, and one is averaging into a trade. If you are averaging into a trade, you are in a bad trade. Never average into a trade. If you're in a trade and it goes against you, you should be a 50-cent stop. You get out and move on to the next trade. If you're in the trade and it starts working, you start taking a profit, move your stop up, and start putting money in the bank. That's what successful traders do. Unsuccessful traders don't have a stop order. They watch it go up $3. They watch it go down $3. They buy more. It goes down $3 more. They buy more. They're suddenly long 10,000 shares. They're down $5,000, and they've blown up their trading account. So I'm giving you the 2 scenarios of what successful traders do and what unsuccessful traders do. It's actually really simple. We tend to overcomplicate it. So get out of your own way and follow the rules.